Welcome to my channel. In this video, I am going to teach and demonstrate an inside bars trading strategy. This video is an update to my previous video on the topic. You will learn what an inside bar is, the various types of inside bars, the strategies of trading inside bars, how to trade inside bars, false breaks, and errors traders make while trading inside bars. Let's start. Don't fail to subscribe and hit the notification bell. What exactly is an inside bar? An inside bar in Forex is a two-candlestick pattern that occurs when the high and low of the second candle are both contained within the high and low of the first candle. This means that the second candle is completely inside the first candle. The inside bar pattern signals a market pause or indecision, and depending on the price context it formed in, this can give us a very important hint about what the market is about to do next. The inside bar is one more tool in your price action toolbox that you can use to enhance your trading strategy and, once mastered, increase your chances of long-term trading success. How standard inside bars look like. Inside bars can form exactly in the middle of the mother bar, or close to either the high or low. There is no exact way they have to look, only as long as they are contained inside a high to low distance of the mother bar. We have four variations of standard inside bars. 1. Double multi-inside bar. 2. Coiling inside bars. 3. Fakey pattern inside bar false break. 4. Inside bar pin bar combo pattern. In our video titled Inside Bar Trading Strategy, we explained all four inside bar variations in detail. Check out the video link below. Traders view the formation of an inside bar pattern as the market's hesitancy to push prices higher or lower. This could be for a variety of reasons, including, a very important financial news item is about to be released, or, the market has recently made a tremendous move. And traders are wary of bidding prices that are considerably higher or lower. Whatever the reason, the goal is the same: to capitalize on possible volatility in order to increase profits. When traders are unwilling to bid prices higher or lower, it is viewed as a prospective setting for future rises in volatility. The inside bar candle pattern is not telling traders that the market is bidding the price higher or lower, but rather that the market is waiting before making the next big move in the asset. This means potential opportunities for traders. We are going to discuss different ways to trade the inside bar. And 3 common errors traders make when trading the inside bar strategy. There are many different ways to trade the inside bar strategy in Forex trading. Here are a few of the most common. Breakout trading. This is the most common way to trade inside bars. The idea is to wait for the inside bar to break out of the range of the previous bar, and then enter a trade in the direction of the breakout. Here is a further example of a breakout strategy in a bearish trending market. You can see the entry after the breakout. Here's another example of a trending market, with inside bars. Because the market was heading higher in this situation, the inside bars would be referred to as inside bar buy signals. Take note that in powerful trends, such as the one in this video, many inside bars patterns will occur, presenting you with multiple high probability entrances into the trend. Always seek to enter a trade towards the existing trend. as long as there is no support or resistance line where the inside bar is formed. Here is a further example of a breakout strategy in a bullish trending market. You can see the entry after the breakout. The chart shows how well this price action structure performs as a continuation pattern. To be honest, you will not take into account all of these signals. You should look for entry points in the direction of the bullish trend. You should also be mindful of key chart levels, such as support and resistance levels. You must not enter a trade close to key chart levels unless you are targeting a reversal of such a trend. Then you can trade the reversal. Trading inside bars against the trend from key chart levels. Reversal trading. Inside bars can also be used to signal a reversal in the market trend. For example, if the market is trending up and an inside bar forms at the top of the trend, this could be a signal that the trend is about to reverse. Triangular inside bar. This is a type of inside bar that forms a triangle pattern. Triangular inside bars are often seen as a sign of indecision in the market, and can be used to trade both breakouts and reversals. Inside bar with engulfing candle. This is a type of inside bar that is followed by a candle that engulfs the inside bar. This can be a strong signal of a trend reversal. Trading inside bars against the trend from key chart levels. In the video example, we are trading an inside bar pattern against the prevailing daily chart trend. Price had retraced back to test a key support level, forming a pin bar reversal at that level, followed by an inside bar reversal. Take note of the tremendous upward push that occurred after this inside bar setup. Traders must avoid entering trades against the prevailing trend when it has reached key support or resistance levels. Traders should rather look for reversals. Here's another example of trading an inside bar at a significant chart level against the recent trend or momentum. We were trading an inside bar reversal signal from a significant level of resistance. Also, the inside bar sell signal in the example you are seeing on the screen had two bars within the same mother bar. This is entirely normal and something you will see on the charts from time to time. Trading inside bars from important levels of support or resistance may be quite profitable because they frequently lead to huge moves in the other direction, as shown in the chart. Inside bar false breakout or fakie pattern. A false breakout from an inside bar pattern is usually known as fakie pattern. A fakie pattern occurs when price initially breaks out of an inside bar pattern, but then soon reverses, producing a false break, and closes back inside the mother bar, or inside bar's range. Inside bar, plus false breakout, is known as fakie pattern. A pin bar may or may not serve as the false break bar in a fakie pattern. The false break bar could also be a two-bar pattern, with the first bar closing outside the mother bar, or inside the range, and the second bar completing break by closing back inside the range. Fakies or inside bar false breakouts are an extremely powerful, and vital part of price action trading because they may show us when the big boys are stop hunting, and give us a very solid indication of what the market will do next. Every price action trader should take seriously learning how to trade the fakie pattern, since it is an essential asset to have in your trading armory. Stop hunting is a strategy that attempts to force some market participants out of their positions by driving the price of an asset to a level where many individuals have chosen to set stop-loss orders. A false inside bar breakout always comes after an inside bar setup, as shown in the illustration of various fakie patterns. The four examples above are the most typical styles of fakie trading techniques that you will see on the charts, though they can differ somewhat from the ones you see here. How to trade inside bars false breakout fakie patterns. Fake patterns can be traded from important chart levels in trending markets, range-bound markets, or even against the trend. In order to avoid falling prey to false breakouts, which so many traders do, it is crucial to learn how to trade with the fakie pattern. False breakouts are common in the Forex market, so learning how to do so can help you profit from them. The following are some of the most typical entries for a fakie signal. Number 1. After the initial false break, enter as the price breaks back past the inside bar or mother bar, low or high. It may be a stop order entry or an entry at the market price. The second. You can employ a pin bar trade entry if the fakie pattern contains one. Trading fakie in a trending market. Let us look at some other examples of trading fakie signals in different market conditions. In a trending market, the chart below displays a good example of a false buy signal with a pin bar as the false break bar. It is worth noting that there were 3 inside bars within the mother bar pattern in this signal. This is rather typical, and you may witness 4 inside bars within a mother bar preceding the false break. Trading false breakout against the trend from key chart levels. The following example is of a counter trend. That is, it is a deception implying that the price may go against the recent or near-term daily chart momentum or trend. Following a move lower, a bullish fakie buy signal appeared near a critical support level in this example. Because this fakie signal was so nice, apparent, well-defined, plus it had the important support level confluence under it, it was a counter-trend fakie worth taking. Another counter-trend fakie pattern is shown here. It was a bearish fakie sell signal from a critical resistance level this time. Take note that the market was definitely advancing just previous to the development of this fakie. The fakie then false broke over a major resistance level in the market, giving weight to the likelihood of a move lower. The massive sell-off that followed this bearish fakie is visible. Tips on trading the fakie pattern. Not every fakie pattern is worth trading. Look for patterns that have confluence and make sense within the underlying market picture. Start by trading fakie signals on the daily charts. Once you have gained experience and confidence, you can move on to lower time frames. Use a stop-loss strategy to limit your risk. Trade in the direction of the trend. Do not trade fake patterns in choppy markets. It is important to note that the fakey pattern is a complex price action pattern, and it takes time and practice to learn how to trade it effectively. 3 common mistakes traders make when trading the inside bar strategy. If you know how to trade inside bar patterns effectively, it may be a very significant price action signal. Unfortunately, a lot of traders lack the knowledge necessary to trade it effectively, and as a result, they repeatedly lose money and lose patience with inside bars. Trading the inside bar setup involves intricacies, just like trading any other price action signal, and understanding the differences between a good and bad inside bar signal can make the difference between profiting and losing money with them. That's not to imply that after you learn how to trade inside bars, every trade you make will be profitable, but you should at least ensure that you are positioning yourself to profit from the inside bar pattern. Keep watching to find out what they are, and how you can prevent them as I explain the 3 most expensive mistakes I see traders making with the inside bar pattern. Number 1. Not trading inside bars on the daily chart. For a price action trader, the daily chart is the most dynamic and crucial time frame. Having said that, if a signal arises on the 4-hour and 1-hour charts and it meets my entry criteria, I do trade some price action signals on those time frames. The inside bar pattern is one price action pattern that I only trade on the daily chart time frame. Here are my primary justifications for doing so. An inside bar on the daily chart represents a period of consolidation on the lower time frames, and it can be a signal that a potential breakout is coming. Inside bars are less reliable on lower time frames because they are more common and more likely to lead to false breaks. This is because lower time frames are more influenced by noise and market fluctuations. By using the daily chart to identify inside bars, traders can eliminate a lot of the confusion and over-analysis that can lead to overtrading on lower time frames. This can be a significant advantage, especially in choppy and sideways markets. If you look at the 2 charts on the screen, the daily chart shows a single inside bar that represents all the sideways movement on the 1-hour chart. This inside bar worked out as a sell signal, while most of the 1-hour chart inside bars failed. This is because lower time frames are more influenced by noise and market fluctuations, which can lead to false breaks and inside bars that do not lead to meaningful price action. By focusing on trading inside bars on the daily chart, traders can avoid these false signals and improve their chances of success. 2. Not trading inside bars in line with the daily chart trend. As previously mentioned, I prefer inside bars on the daily chart with the trend. It's incredibly challenging to attempt to trade inside bars against a daily chart trend, especially if you're a novice or new trader. It is possible, but it should only ever be attempted from key chart levels until you are confident and effective trading inside bars with the daily chart trend. An inside bar can be viewed as a breakout play, and can offer very excellent risk-reward potential to get on board a trending market as it resumes its upward trajectory, following a brief halt or consolidation. Inside bars are best traded as trend continuation patterns on the daily chart. Number 3. Most traders use too tight stop loss. It is sometimes a mistake to place your stop loss exactly above or below the mother bar high or low of an inside bar. Stop losses must not be placed based on greed, which means they cannot be placed too close to your entry simply because you wish to trade a larger position size. You must arrange them sensibly, where they have the best chance of avoiding the typical daily price changes. Placing your stop loss just above or below the mother bar high or low of an inside bar can be risky, as it can lead to being stopped out prematurely. Here is why. The inside bar pattern is a continuation pattern, meaning that it typically signals a continuation of the current trend. As such, price is likely to break out of the inside bar in the direction of the trend. However, there is always a chance that price will break out in the opposite direction, especially if the inside bar is large or if it forms at the end of a long trend. If you place your stop loss too close to the mother bar high or low, you are at risk of being stopped out on a false breakout. This is especially true if you are trading in a volatile market. To avoid this, it is generally best to place your stop loss outside of the mother bar. This will give you more breathing room and allow your trade to play out. Make sure your stop loss is placed beyond the average true range, ATR, and any key support or resistance levels. This may require you to reduce your position size or risk-reward ratio, but it is important to do so to avoid large losses. Average true range, ATR, is a measure of volatility. It is calculated by taking the greatest of the following three values: the current high minus the current low, the absolute value of the current high minus the previous close, the absolute value of the current low minus the previous close. Key resistance levels are price levels where the market is likely to pause or reverse direction. These levels can be identified by looking at historical price charts. Position size is the amount of money you are willing to risk on a single trade. Risk-reward ratio is the ratio of your potential profit to your potential loss on a trade. Here are some tips for placing your stop loss on an inside bar trade. If you are trading a bullish inside bar, place your stop loss below the mother bar. If you are trading a bearish inside bar, place your stop loss above the mother bar. You can also use a trailing stop loss, which will automatically move your stop loss higher as the price moves in your favor. It is important to note that there is no one-size-fits-all approach to placing stop losses. The best placement for your stop loss will depend on your individual trading style and risk tolerance. Thank you for watching. Don't fail to subscribe and share the video so that your friends can see it.